Let me start with the first question, and this is a question that I think Himanshu, did touch upon on his presentation, but I think a very important and pertinent question that Gopal Srinivasan has asked. And there are two questions that I'm just combining it into one, and I'll give it just to what he's trying to understand. One is that, there's a wide variation in ratings between rating agencies. Obviously, we'll talk about specifically about our own ratings. And secondly, I think what he also wants to understand is that typically what is seen that, there could be instances where funds might have a higher return over a time period, but it gets, poorer star rating as compared to another fund in its peer group, which probably has a lower return. And secondly, there can be variations between, a well-rated, star-rated fund versus the analyst rating or vice versa. So, Himanshu, if you can address that.
Yeah, sure. Thank you, Kaustubh. And a very interesting, actually, query. So let's start with the star rating process. One thing that you need to understand is, there can be a difference. Say, for example, if a fund has done well over a 5-year period, it may not necessarily that it may get a high star rating, because star rating does take into account the volatility that the fund would have witnessed. When you look at the point-to-point performance does not take into picture the risk that the fund has taken to reach to that performance, whereas the star rating does take that into account. So how that works is, given if the fund has a large variation in its performance, then it does get penalization point, especially on the downside. If the fund has a higher downside over that 5-year period, the fund gets penalization point compared to if it has a better performance, upside deviation. Upside deviation is something that investors will not mind, but downside deviation is something that investors don't like. And that is where we penalize those funds. That part is taken into account. So yes, there are chances that the fund may have point-to-point performance, which is very good. But if it has taken higher risk, if it has been highly volatile fund over that course of time, those things will be taken into account when we generate star ratings, and the fund will see a drop in its star ratings. Now, coming to analyst rating. So there are chances then, and it happens very often, that we have a fund which is highly rated in terms of analyst rating, maybe silver or gold, but it does not have a high star rating. The reason is analyst rating are not performance trackers. It doesn't track performance. What we essentially saying is we are analyzing funds subjectively on a qualitative basis, where we are checking the team, we are checking the performance, and we are checking the culture of the parent. And these are the building blocks of our analyst rating. And we feel that if these building blocks are in place, the performance would follow. We are not seeing the performance at this point in time. What we are trying to understand, even a lot of time what happens is, if there is a performance, the strategy might be out of favor. If we see the markets of 2017 to 2020, value didn't do well. Value-oriented fund didn't do well, but that strategy was not favoring that kind of a strategy. Now, their performance may look bad, but when we look at from our perspective, our lens, we know that this is a strategy that will do well when the value theme will be there. The manager is playing to their theme, the manager is sticking to this strategy, and there is no point in penalizing them. Because these are the markets when these strategies will not outperform. So these are the aspects that drive our analyst rating. So a big takeaway, analyst rating are not performance trackers. So if you have to select or make a decision based on star ratings or analyst rating are future-driven rating, forward-looking. So I would recommend you stick to analyst rating than star rating in that case.
I can take up the next question, which is on, so this question has come from Shiva, which is an interesting one, is that how can I hedge my mutual fund investment returns, from eroding during market downturns, right? And that's a challenge, right? That all of us face that, when there are downturns, how do you protect that downside? So I would think that I don't think there is a direct way to hedge those returns, right? I mean, I think some of the stuff that we spoke about during the earlier discussions with, the panel discussions and what Chintan also referred to is the importance of diversifying your portfolio, right? And maintaining an asset allocation that is aligned with your goals and your risk appetite and your investment horizon, right? So I think those are the main drivers of long-term performance. So in other words, if you're going to be heavily invested in equity, say if you're going to be 80-90% invested in equity, you'll have to live with these downturns, right? I mean, you'll have to live with the market volatility, right? So and if you're uncomfortable with that kind of volatility, it's best to probably maintain a more sort of conservative or a balanced kind of an allocation, right? So I think, I would think that is the way to approach it. There is no direct way, unless of course you're trading directly in stocks, then you could, say, get into derivatives, but which is not the ideal thing to do. But when you talk of only mutual funds, I think, that's one approach you can take. The other way to look at this is if you're unsure about, how much allocation to maintain to equity and debt in your portfolio, you could look at some of these, the balanced advantage fund kind of categories or portfolios or funds or strategies that manage that equity and debt allocation. It's sort of effectively managed, by or decided by the fund manager based on their views. So that's one way in which one can, in a way, reduce the risk. I wouldn't say hedge the mutual fund returns, but it would reduce the risk in your portfolio as well.
Sure. Thanks, Dhaval. So I'll there are a bunch of questions that are coming about, and I think it's very important to address it. So Deepak Muralka has asked a question, and there are several others who've kind of alluded to this. Is it, after seeing what's been happening at Axis Mutual Fund, whether other asset management companies are also doing any additional due diligence to ensure that investors don't get any such surprises in the future? And how can investors be sure that nothing of that sort is happening, right? Because, as rightly pointed out by Deepak, it's important to get the confidence of the mutual fund investors, and that's obviously a very important thing to talk about, right? So I think, firstly, obviously what's happened is very, very unfortunate, and as we speak, obviously the investigation is still continuing, and we hope that that will be concluded soon, and the findings will be made sort of known to all investors exactly what were the controls that were probably breached. But I think the point being that a lot of asset managers already have, and most of them have very, very stringent trading mechanisms, and there will always be certain gray areas which single individuals may exploit. But I think broadly, when you look at it, I think one is that we're very, very the asset managers themselves have only been improving on their risk management processes, their trading mechanisms, and B, very importantly, we have very, very active regulator, right? So obviously they've been doing a lot of surveillance on their own, and you would see news about other imposing several fines on, and I think there was recently something in the news today too about someone getting an excessive fine on front running, right? So I think that's the important bit, that we're one of the most transparent industries, very, very well regulated industries with a regulator who's really looking closely at things. There will be instances where there could be cases where someone has exploited a loophole or something like that. But I think the whole point being that I think we should have faith in an industry which is so well regulated, and let's just wait to see what comes out of this investigation. Till then, I would advise investors to just stay put. That's really my 2 bits on this case.
Okay, thanks, Kaustubh. I think there are a couple of questions around what's our view on gold and what kind of allocation can investor basically look at. Maybe I'll just try and answer that. So, when it comes to gold as an asset class, obviously there are a couple of factors which impact the price of gold. At this point of time, obviously one would view that gold typically has been able to provide hedge against high inflation as such, but right now the interest rate environment that we are in is something which is trying to negate the positives of it acting as a hedge against inflation, and the other part is that unlike equities, gold doesn't have any underlying cash flows. So if we have to, value gold, if we have to, build a fair value on gold, it is, extremely difficult or not possible to have a fair value on gold and accordingly see whether the current, gold price is, say, overvalued or undervalued relative to its fair value as such. But despite all of this, I think for an investor, it might make sense to have anywhere between say 5 to 7 or max 5 to 10% kind of allocation to gold in their portfolio, be it in digital form or be it in physical form, to try and benefit of it as a fundamental diversifier. Lately, we have seen gold also experience some bit of volatility, but again, over an extended time period, it still acts as a fundamental diversifier and might make sense to have anywhere between 5 to 10% exposure to gold.
Thank you, Chintan. We have a query from Mayur Mishram. There have been a lot of changes within various funds, fund manager changes, and how should one decide if there are change in managers? So there are multiple scenarios that can, evolve given the change in the manager. One of the thing is the fund is taken over by the same by a same experienced manager, same tenured manager. For example, the new manager has experience, has managed such strategies in the past. And I'll give you the example, something that I've shown in my presentation also is ICICI Prudential Value Discovery Fund. Now, for almost 10 years, this fund was managed by Mrinal Singh. Mrinal Singh exited the fund house in Jan 2021. That was taken over. The fund was taken over by Sankaran Narain. Now, Sankaran Narain is more experienced than obviously Mrinal Singh, but he's also good in value investing. And this fund actually is a value fund. So here we see that the manager's skill set is in line with the investment proposition of the fund. Another important aspect here to note is that Narain has managed this fund in the past as well, from say 2005 to 2010 or 2011. So this is not something new that he was doing it. He was a part of this fund. He is the CIO. Here we had a manager who has the experience, has the skill set to run a particular strategy. No change there. We retained our rating. In fact, we upgraded the fund from silver to gold. And in such scenarios, investor doesn't really have to bother about the change in the manager. But let's take a scenario where there's a change in manager, where a new manager is actually new. He doesn't have a past experience, but then he might be a part of a very experienced team. And if he's a part of a very experienced team, he has all the resources to deliver performance. But obviously, manager skill set is also very important in such cases, because ultimately the buying and selling decision, the thought process comes from him. Now, in such a scenarios, I will never recommend a knee-jerk reaction to exit immediately. I think there is a need, you can watch for some time. The idea that you can have, or something that you can do, is you don't put additional investments into it, retain your investments, observe it over a period of time, and then make a decision, rather than just based on manager change. Because when we are analyzing fund, we are not only taking a call on the manager, but we are actually analyzing the entire team altogether. And there are times when we have seen that the manager might not be as great, but their team which is supporting him is actually exceptionally good and well structured. And that enables the manager to perform his duty effectively. So this is how you need to look at manager changes.
Yeah, I can take up the next question. So there are a bunch of questions around, flexi cap funds and also, how many funds should one have in a portfolio? So, there are questions from Archana, Ravi, Mehul, and Sanjay that are around the same kind of topic. So I would just, try and combine them and address them together in that sense. So in terms of, how many funds should one have in a portfolio, right? I mean, that's a pretty good and interesting question, right? I mean, so now it depends on two things. One is the kind of exposures you want to take at your end. Are you able to take those calls? So for instance, if I give the example of the strategies that we manage out here, or the managed portfolios that Chintan spoke of in the previous session, these are multi-asset portfolios or strategies which are investing across Indian equity, fixed income, and international equity. And within Indian equity, we split across large, mid, and small cap, fixed income across cash, short-term, medium-term, and long-term debt, and international across US, emerging markets, and Europe as such. So, there are a bunch of different, segments of the market or asset classes that we invest in. And typically, we like to take pure play exposures to each asset class. So what that means is that, if I want a large cap exposure, I'll invest only through a large cap fund, and similarly mid cap and small cap separately. So in that kind of a scenario where we have separate exposures to each of these asset classes, we will typically have anywhere between 12 to 14 funds in a portfolio, right? And because the number of asset classes is large, on the international side, for instance, I'll have a separate US equity fund, a separate European, and a separate emerging market equity fund. Now, from your perspective as an investor, it would depend on whether you're comfortable taking separate exposures, or would you want slightly broad-based exposures and leave it to the manager to take a call. So for instance, you could replace separate large, mid, and small cap funds with a flexi cap fund, right? Where the manager is taking the call in terms of, what is the, how much to invest across, large, mid, and small cap kind of buckets. So similarly, international, you could invest in a global kind of a fund as well, where again, the manager takes the call in terms of which geography to invest and so on and so forth. So in that kind of a scenario, maybe you could look at anywhere between, say, I would say about 7 to 10 funds in a portfolio. I would say the other important thing to keep in mind is also the weightage that you assign to each of these funds, right? Eventually, that's an important factor as well. And typically the way we see this is when it comes to large cap kind of funds, the maximum weightage that we try and look at in the portfolios that we run is at about 16 to 17%. So we don't exceed, 16 to 17% to a single sort of large cap fund. And if you're looking at mid and small caps, maybe it could be a little more diversified, because typically we see that there is a lot of variation in performance in the small and mid cap kind of category. So you could have, a couple of managers on the mid cap side and a couple of funds on the small cap side as well. So net, I would say you can look at, a minimum allocation of about, I would say about 4 to 5% to an individual fund, and a max allocation of about, 15 to 17% to an individual fund as such. And just the other point around, flexi cap funds, there was a question around, should we can we invest in 2 or 3 funds in the same category, say flexi cap and so on. So I would say again, yes, one is to keep in mind is not to over diversify your portfolio. Maybe a couple of flexi cap funds just to get, because each manager would have a separate view. So it's important to diversify that view as well. So you could have, maybe a couple of managers, but typically, one has to be mindful, like I said, of not overly diversifying the portfolio as well when one is constructing it.
Thanks, Dhaval. So I'll, there are a whole bunch of questions around, index investing and active versus passive. So then, for instance, there's a question from Jagdish who talks about, should DIY investors, who want to take exposure, can they do an SIP in an index ETF? Then there's, additionally, there's a question from someone called Eagle Eye who's talking about that, the index ETF penetration acceptance in India is still quite low as compared to when you look at markets such as the US. And Satish asked a question, which is better, active versus passive, right? So let me look to address, elements of these questions. So firstly, I think there is no right or wrong answer to, that, is active better or passive. I think there's merits in both, and I'll explain why. But I think, clearly the first thing when you think about from an Indian context is that we still think there are good managers, good actively managed strategies that can and will beat the benchmark going forward. Obviously, we've had some dissonance over the last couple of years when there was a very polarized market, and a lot of active managers did drag the performance in terms of the benchmark. But I think going forward, there will be managers and a reasonable number of managers that will continue to beat the passive strategies. That's there. But I think a couple of important points that are very very important to articulate here. One is that my colleague Himanshu spoke about the study that we've done in terms of critical month study, and that becomes a very important point to talk about, simply because we've seen that the important or critical months of performance can come at different points of time for different kinds of strategies. Now, the biggest challenge for investors is you identify a good manager, you need to be patient with them across a market cycle. Very often what we've seen is that if a fund is underperforming over the recent times, investors could look to exit that and get into a better performing fund that has performed well in the recent past. Now, that could be a double whammy, simply because you're exiting a fund that probably has those good months of performance around the corner and entering a fund where the good months of performance are probably past in the recent time history. It's not that the fund's gone bad, but it's just that maybe the style is not in favor, right? I think the classical case that we spoke about, growth versus value. Growth funds did exceedingly well, in the years of 2018, 19, maybe the first half of 20. But since then, the more cyclical value plays have come up. Now, when we look at trends in the market, we can clearly see that, investors are, they move to growth too late in the cycle and then now maybe looking to shift to value. The idea is, and alluding to what Dhaval said, build a portfolio that can accommodate both styles, in your portfolio, right? So the point that I'm making is that there are good active strategies. You just need to hold them over a market cycle and don't try to time your investing in that, right? The second case for active investing and why that's important, and addressing the question that why active investing is not necessarily picked up as compared to India, is when we think about it and the scope, right? Let me just put some numbers in context here. Mutual funds as a whole own about 8.5% of the overall market cap of the Indian equity markets, right? In the US, the same comparable numbers north of 30%, which means, US mutual funds own 30% of the US market cap, right? So when you as a full set own 30% of the market cap, and if you think of the market as a zero-sum game, there are winners and there are losers. Obviously, if you're such a significant proportion of the overall market, there are going to be challenges in terms of a large portion of managers beating the benchmark, right? There will still be good managers and strategies that will beat it, but the proportion will be small. I think in India, there's still some way to go. There will still be, reasonable number of active strategies and managers that can beat it. But your job as an investor or your advisor who's advising you is to find those strategies and just behaviorally stay invested, right? I think that's the crucial part. Where does index fund become very, very useful? If, and Sagneet spoke about choice paralysis, right? If you're presented too many options, sometimes you just make no decision at all. And obviously, if you're an equity investor, you need to be in the market to make money from the market, right? Chintan shared those examples about how if you lost the 10 best days, your return was so much lower than the market. So if you're faced with this choice paralysis that I cannot decide what fund to buy, I think index funds becomes this beautiful construct where you're just buying the market and just staying invested because you're not having to deal with, which active manager should I buy, the behavioral biases of chasing recent trends. So I think that's kind of the broad underpinning thought when I think about active passive. Definitely for both to coexist. They coexist in the markets like the US also. So I think there's nothing different from an Indian context. I would advise investors to look at it from that lens. So that's about it from my end on that.
Okay, thanks, Kaustubh, on that one. Maybe I'll take up the next one. There are a couple of questions around, what should be the, rebalancing strategy, or should one just stick to, buy and hold? There's a question from Ajit. There's a question from Praveen as well around that. So actually, this is something which is, purely subjective. Now, the key thing to basically look out here is, what is the remaining investment horizon that you have, and where do you stand at present? Because say, for example, you started with say a 70-30 kind of split between equity and fixed income, and because of the market movement, say during March 2020 during the pandemic, if your 70% allocation came down to say 50 or 55%, but as per your risk profile, 70% is something that you should actually have on the equities and rest on the fixed income side. So there is a significant negative drift in terms of where you stand versus the allocation that is desirable for you for your risk profile. So you need to basically add equities to again come back to that 70% kind of mark. But this also works on on the other side as well. Now if because of a sharp market rally, if your 70% allocation has moved up to say 80-85%, definitely there is some bit of rebalancing requirement. You need to book some profit and then try and shift that allocation from equities to debt, because what eventually would kind of happen is that if you don't do such kind of rebalancing activities, and if you simply follow a buy and hold approach, your equity allocation or any other asset allocation will be a lot more than what is actually suitable for you, for that particular risk profile. And as in when you approach your investment goal, it will see a lot more volatility. It will see a lot more instability in terms of the actual portfolio value because of much higher exposure to a volatile asset like equity versus what ideally it should have been. So there is no clear way to basically look at this. It is purely subjective, and for someone who has just started investing, maybe buy and hold kind of approach might be suitable if that person has an extended time period investment horizon. But for someone who is approaching an investment horizon or is seeing a major drift between the allocation that is desirable for them versus what it is right now, they should try and rebalance the portfolio.
Okay, so we have a question from Mr. Rahul Shah. He says that is it wise to replicate the portfolio of best performing mutual fund? Can we invest in the same stocks directly which are invested by fund managers to make more returns? This is one of the very common questions that we also get and very often. The answer is why you want to, if this is a good fund, why you want to replicate the same thing? Unless means you can just directly go and invest in that fund and be at peace, because the point is the manager's thought process will be very different from the way you are gonna approach it, and it means you need a lot of skill set to do that. And believe me, replicating a mutual fund, a lot of people have tried to do that, but unfortunately there are not many people who have been able to do it successfully. So my recommendation to you is don't fall into that trap. If you want to invest in a mutual fund, go and invest in a mutual fund rather than replicate the same thing at your end, which is far more humongous in task and require a lot of resources to do that.
There is one question around, does it make sense to make a prepayment for my home loan given that interest rates are rising? I think that's a fairly valid question in the current scenario, because there are expectations that rates will rise further. So if you have, it's ideal, to try and prepay some portion of the home loan if you are in a position to be able to do so. But I would also suggest that you should balance. I've seen a lot of people who liquidate a bunch of their investments and prepay large portions of the home loan. So I think that may not be entirely advisable. I think you should continue with your investments as well. Maybe a small portion, if you have some surplus coming through, say a bonus or through other routes, and use that to prepay a part of your home loan. I think that would probably be more advisable. And the reason for that is that creating a corpus and the compounding benefits that you get over a period of time, those only those actually come through when you hold the investments for longer periods of time, right? So therefore, I think it's important to stay invested unless you're obviously, as you draw closer to another goal, say it's a retirement goal, or it's for a child's education or anything else, then naturally you would need to sort of move those investments into more into cash or liquid assets to be able to meet that goal. But otherwise, I would say for purposes such as prepayment of home loans, I would say probably one shouldn't do it by redeeming in a very big way from the portfolio. I think one should use other surpluses to sort of try and do that.
So we have another question from Mehul, which states that how should I decide which sector fund to invest in? Now, Mehul, I did address this segment or this part in my presentation as well. And the answer is, if you have an idea as to where the sector is headed, if you are able to analyze a sector, time you entry and exit from that, if you're a knowledgeable investor enough to understand the dynamics of the sector, then you can go ahead and invest in a sector fund. If you are not, even with recommendation, you need to have that continuous recommendation available at you, someone who can explain you and guide you as to when to invest in that and when to exit from that, because sectors are cyclical in nature and there can be sharp outperformance as well as sharp underperformances as well. And that does have an impact on the overall portfolio. So if you have those segments, if you have those wherewithals and knowledge around that, then you can select a sector fund. Otherwise, as I recommended in my presentation, you should go and invest in diversified equity funds. Sector funds or the managers are really, they don't have the mandate to invest in some other sector if the underlying sector is not doing well. Whereas in case of diversified equity funds, the managers has the capability as well as the mandate to invest across sectors. So if one sector is not doing well, they will move towards another sector. And that is something that will be very difficult for you to do it at your end. So my recommendation is, if you have those knowledge base in place, then you can select a sector fund. Otherwise, stick to diversified equity funds.
Okay. There's a next question from Pranay Kumar, who wants to understand about investing in debt funds for a shorter time period of, say, 6 to 18 months, and particularly if that money needs to be moved on to equities over a period of time. So again, out here, what one can basically try and do is split the allocation between the ultra short term funds and say low duration funds, or maybe even liquid funds, because the investment horizon is pretty short, and the purpose of this investment is to park money on a short-term basis and then eventually do STPs and move on to the equity side. So these are a couple of categories on the fixed income side which one can consider to basically park short-term surplus.
There is a question from Mr. Vasudev Puranik. Is there an all-weather mutual fund category that has potential to deliver better risk-adjusted returns from 10-year investment horizon? I think you should not go with the category per se. You should rather look at the portfolio in a very holistic manner. The idea is to construct a portfolio which has a mix of categories, which has a mix of different investment styles, which has a mix of various market segments in your portfolio, which can help you achieve your financial goals over a longer period of time. For example, as I mentioned earlier as well, if you invest in a large cap funds, large cap funds typically provide stability during market downturn compared to mid and small cap stocks or mid and small cap funds. But at the same time, mid and small cap funds can provide you that additional return when the markets are rising. So I think that a mix of all these will help you achieve the right portfolio allocation. One category I don't recommend going ahead, largely because diversification is important. What you need to check, obviously, and Dhaval has alluded to that in his presentation and when he was speaking earlier as well, that you have to check where you are going over diversified, because on an over diversified front, you are not actually generating additional returns. So that is something that needs to be checked in mind. As long as your portfolio is well diversified across categories or market segments, rather, I would like to put it that way, that will help you achieve better results.
Sure. Thanks, Himanshu. I think, there are a few more questions, but we seem to have run out of time. So I think we'll have to call it a day for today. What we can do is we can try and address some of the questions that we haven't been able to cover today. Separately, we can write back, to the people that have put in those questions. And also feel free to sort of post your questions on our website, the Morningstar.in website, which Himanshu was also showing us earlier. There is a space to, which is a section called as Ask Morningstar. You can put in your questions out there, and we'll be happy to address them. And I think with that, we'll sort of call it a day today. Thanks to all the participants for joining in. We hope it's been a useful session or a bunch of sessions for you today. As I mentioned earlier, do feel free to post your comments and questions on the Ask Morningstar tab. And we look forward to more interactions with each of you in the future.